Welcome to the lecture number 33. In the last class, we have defined what is capital budgeting and what is the time value of money and what is the application of time value of money in capital budgeting. So in this lecture, I shall discuss about in the capital budgeting decisions, how do you evaluate whether you should go for a capital budgeting or not. Now, after these sessions, what you'll be able to, you'll be able to find out that whether we should actually go ahead with a particular capital budgeting or investment in the non-current assets or not. Now, let us explain this concept with the help of an example. An entity plans to invest 100 lakhs of today for purchasing a machinery. Should it purchase this machinery today? So the activity before it actually purchases is called capital budgeting decisions. Now, first question we have to ask is that, what is the capacity utilization of other machines? If it is high, yes, that makes sense. If it is low, why it should not increase the capacity of the existing machines? Next, is this when you use the machines or when you procure a machine, from that output would be there, is there a sufficient demand of the output? If it is yes, then it can be considered for purchase. If it is no, then why I should actually invest in the non-current assets? As we know, higher asset does not mean good, because if you see the fundamental principle of finance says that optimize the assets. So if there is not much of a demand, why I should make an investment? What would be the present value of cash flows to be generated from the output of the machines? So we have to calculate that, okay, what would be the output? Now let us look at it. As we have discussed, for every capital budgeting decision, there should be investment period. Suppose investment period is 6 years. So I have to calculate this cash inflow over a period of the 6 years. Now, so that means, please remember, if I'm investing today 100 lakhs, the inflow will come year 1, year 2, year 3, year 4, year 5, year 6 for the investment period. So I need to calculate the inflow, cash inflow of each year. To get it, I am explaining it for year 1. What would be the cash inflow formula? The cash inflow formula is PAT plus non-cash expenses plus finance charges. Which financing charges? Financing charges associated with this particular asset. Minus delta current assets minus current liability, delta gross fixed assets. Now, delta current assets minus current liability is the accrual part, that is the amount of money blocked. And delta gross fixed assets is the routine capex. Routine capex means even if I take the asset, now from that routine capex I have to carry out. So these would be out. Now, if you look at it, this is the cash inflow of year 1. PAT, non-cash expenses, finance charges. Why finance charges? Because before I pay any charges on account of finance for this machinery, which I have taken, it has to be added back. Before that, I am evaluating it. And next part is that increase in current assets minus current liability. In the current assets, I am excluding cash and bank balance. Now, what does it mean? If you can correlate with what we have discussed in the cash flow, delta current assets is money blocked. Delta current liability is that how much of that money, how much of that blocked money is funded from creditor or bank borrowing. So delta current assets minus delta current liability, that is delta bracket current assets minus current liability. It means that the amount of money blocked less the amount of money already financed. So whatever is left, that is deducted from the cash generated. And from that, I am also deducting the routine capex. So this part talks about the total cash generated. Now from that, some money is, so this is PAT, it consists of both cash, accrual, everything. Non-cash expenses I have added back, finances added back. The money which is blocked, which is delta current assets. Now, if delta current assets is also being funded from delta current liability, that is other current liability and bank borrowing. So whatever is left, that money has to be deducted from it. Apart from that, I will also deduct the money which is used for the routine capex. So cash inflow of year 1, how do we calculate? PAT of that year, depreciation of that year, the non-cash expenses, finance charges, delta current assets minus current liability, and delta gross fixed assets. Now here, just a very important point. A company may not have only one assets. A company may have other assets also. So in that case, which profit I will take? The concept is very clear. Any incremental profit arising out of these assets would only be calculated here. So that means from these assets, whatever the additional sales I am making, for additional sales, for whatever the additional cost I am incurring, from that we arrive at the PAT. Again, I repeat, suppose a company has got 100 assets. The company is buying another 1 assets. So for that, we are doing the investment decision. So in this case, the PAT will be the total company's PAT. No, it would be what? It would be the, in addition to this asset, for these assets, what would be the incremental PAT? Because of these assets, what is the additional sales and etc. would be there. And that's why finance charges would be only for these assets, whatever the loan etc. and equity is there. So that would be there. So in the real life, people don't do that. People generally basically what we take, incremental cash flow, they take it. But in actual scenario, asset to asset investment criteria should be actually evaluated. Suppose T is equal to 1, T is equal to 2, T is equal to 3, T is equal to 4, T is equal to 5, T is equal to 6. These are the inflows. Now, if I is an inflow, that's a future value. Today we are evaluating. So it's a future value. So I actually discount it by using the discount formula that is called present value of inflow. So present value of inflow of year 1, present value of year 2, present value of year 3, 4, 5, 6, that we find out. So what will be the present value? I calculate the cash inflow of different years and discount it at a discount rate of R%. And then I basically sum it up. That's called the present value. Now you have found out why present value concept is applicable in the case of the capital budgeting decision. Because today I am making an outflow. So if you have to compare whether it's worthwhile or not. If it is worthwhile, that means I need to calculate what is the present value of those future cash flows, which is happening in T is equal to 1, 2, 3, 4, 5, 6. So I calculate this cash inflow of different period and then discount it to get the present value. Now, how do you evaluate? Now I am explaining with the help of an Excel sheet. Suppose the PAT, the expected profit after tax, is this 20, 22, 23, 25, 26, 28. That is from this particular machines. Depreciation, term loan to be taken for this asset. Suppose it has been funded with a term loan of with a loan of 60. 40 is basically the equity part. So in that case, this would be the interest. Now, delta current assets minus current liability. That means year 1, increase in current assets minus increase in current liability. That figure is 5, 7, 6, 5, and 4. This is nothing but the amount which is blocked over and above the amount which is funded from the creditor as well as the bank borrowing for working capital. So that is the amount which is not receiving. Now, gross fixed assets, delta gross fixed assets. Salvage value means at the end of the investment period, the business entity is trying to recover a certain amount, that is called salvage value. So cash flow from investment of an asset. So what is the cash inflow will take place? This is the cash inflow over a period. Suppose discount rate is 9%. In that case, present value is this. So the total cash inflow of the present value is 109.3. So before I invest, I have to do this exercise. Now, one evaluation criteria, what is called the payback period. The investment outlet today, discounted payback time slightly later on, investment outlet today is 100. Now, future value of cash flow is 109.08. So total inflow of 6 years is 147.70. So apparently you can say over a period of the 6 years, I am getting 147 lakhs and I am investing to 100 lakhs. Why I should not invest? You are making a great mistake, because this 147 will come over a period of the 6 years. Today I am spending 100. So those values are not equal. So one of the simplest method what you use is called is payback period. What is the payback? Just simply add and see that how many years it is recovering. So it is basically recovering in 4.35 years. Not a very scientific method. Another is a discounted payback. That means you are calculating the discounted cash flows. So that means you are actually saying that, okay, in 5.52 years, you are recovering the amount. But this is also not a scientific method, because why? It does not give you an idea whether it is generating sufficient return or not. So to get that, we use two evaluations. One is called the internal rate of return or the IRR method. Another is the NPV or net present value method. So what we are discussing here is that once we evaluate the certain qualitative, what is the steps of evaluation? Step one, certain qualitative criteria we look, like for example, capacity utilization, demand, etc. Step two, find out the total investment requirement. Step three is that find out the future cash inflow. Future cash inflow, if you look at, is the PAT plus depreciation plus finance charges of this particular borrowing of this particular asset minus delta current assets minus current liability. What is delta current assets minus? If you can notice that I am repeatedly telling what is delta current assets minus delta current liability, because my practical experience shows that people are not clear about what it is. Delta current assets, that is, means increase in current assets except cash and bank. It indicates the amount blocked. Now, some of the money which is amount blocked, suppose amount blocked is 100, and from that the creditor and bank borrowing for working capital has funded 80. So that means the delta current assets is 100. So that means 100 is blocked from the income PAT what we have calculated. Now from that we will minus the 80 which has already been funded. So whatever is left is 20 has not been funded. So 20, it is not receiving 20. So that means from the PAT plus depreciation plus interest minus delta current assets minus current liability means whatever the cash part is not coming, that you are excluding. So this part is the cash part. So that means from the income, how much cash it is there. But from that also you have to spend something for the routine capex. So that's why delta gross fixed assets I am deducting. Now each year I will calculate, and then once I calculate each year, then I can calculate the present value. Present value means I will be discounting at a discount rate. Now, next important point, okay, I have done all this. Should I go ahead? So for that, evaluation criteria is there. The one evaluation criteria is the payback. Simply add and then you take a decision. Absolutely unscientific because time value is not captured at all. Next is the discounted payback. Okay, it is slightly better than payback, but also it does not tell you whether my investment is generating adequate return or not. To get the project evaluations where we can generate adequate return, my investment is there or not, as well as it is capturing the time value, is called internal rate of return and net present value. Now, always remember, internal rate of return is always expressed in terms of percentage per annum. Net present value is always expressed in terms of rupees lakhs, rupees crores. Now, in the next session, I shall discuss about how we calculate internal rate of return and NPV method. Now, in the case of the internal rate of return, before we go to the next class or next lecture, let me give you how we calculate the, what is the meaning of internal rate of return. The internal rate of return means return generated from the investment. Let me explain it. When I'm investing 100 rupees in the case of the plant and machinery, 100 lakhs in the plant and machinery, it is generating return. So what is it is generating return? I do calculate, that is called internal rate of return. So you use this formula. R is the internal rate of return of investment. So that means the R, the discount rate, which makes this equation 0, will be the internal rate of return. Now, suppose this is your cash inflow and this is your outflow is the year 1 is minus 100 and this is it. So the net is minus 100 and this. And if we do it in Excel is equal to IRR, it will calculate 11.85% per annum. So that means if I invest 100 today, and if I'm generating a cash inflow in different years of this amount, so this investment is generating a return of 11.85% per annum. Now, net present value, the return generated in amount after meeting the desired return, in this case with a discount rate of 9% NPV. Now this is an NPV formula. So always remember, in the case of an NPV, we have to give the discount rate. So here the NPV at 9% of the same cash flow is giving you a 9.03 lakhs of rupees. Now the meaning of internal rate of return is that how much the business is generating. The meaning of NPV is that how much extra amount the business is generating after meeting the discount rate. So this is called the IRR and NPV. I will discuss in detail about the applications in the next class. Thank you so much for listening to this video.